Welcome to the Deep Dive. Today we're really digging into the Q3 2025 trading update for the London Stock Exchange Group, LSEG. And this wasn't just a standard update, was it? Felt like more was going on.
Oh, absolutely. A lot more. Our goal here is to really unpack the key moves. We need to look at the financials, sure, but also the really big strategic shifts, especially around that post-trade restructuring, which is huge, and also how they're talking about their data assets, with AI becoming such a big topic.
Right. And you could feel the excitement around this release, couldn't you?
Yeah.
The management tone was definitely confident.
Very confident. And when you look beneath the surface, you start to see why.
Okay, so let's kick off with the headline numbers. Just lay out the snapshot of the quarter.
Sure. So total income, and this is excluding recoveries, came in at $2,219 million.
Okay.
Which works out to about 6.4% organic growth on a constant currency basis. CC, as they call it.
Right, the CC metric. Always important to strip out that FX noise.
Exactly. And what's maybe even more telling, host speaker, is that gross profit actually grew a bit faster, 6.5%.
Oh, interesting. Why the difference?
Well, it's because their cost of sales only went up 4.5%. So that gap, that's operating leverage starting to show. It's a really positive sign early on.
Yeah, that makes sense. And what about the recurring revenue, the subscription side?
Also strong. The combined subscription businesses grew pretty much in line, 6.5%. And their key forward-looking metric, the annual subscription value, or ASV, that was up 5.6% at the period end. Solid pipeline growth.
Okay, solid indeed. So drilling down a bit, which parts of the business were really driving this? Any standouts?
Oh, yeah, definitely. Risk intelligence was really flying, grew almost 14%, 13.9% organic CC. That's their RegTech compliance stuff.
Wow, okay.
FTSE Russell, their indexing business, also very strong at 9.3%. Then you had markets at 6.3%, probably helped by a bit of volatility.
Sure.
And data and analytics, DNA, that was up 4.9%. So, when management talks about strong momentum across all business lines, the numbers really do back that up. It wasn't just one division carrying the weight.
Okay, that paints a pretty positive picture for the quarter itself. But you mentioned the forward-looking stuff, the strategy. Let's get into the guidance and capital allocation, because that seemed like where things got really interesting.
That's exactly right. This is where they went from, meeting expectations to making some pretty bold moves. They actually lifted their full year guidance for the FY25 EBITDA margin.
Lifted it to where?
Right to the top of the original range they'd given. So now they're targeting around a 100 basis point improvement organic constant currency just from operational improvements, things like operating leverage, cost control.
A full percentage point uplift just from operations. That's quite significant on its own.
It really is. And alongside that, they kept the free cash flow guidance, the equity FCF, strong. Still looking for at least £2.4 billion.
And CapEx.
Yeah.
Still investing heavily.
They're keeping it around 10% of total income for this year, yeah. But they did signal that the intensity should start to come down a bit going forward, as some of the big internal tech projects wrap up.
Okay. So strong cash flow, good margin improvement. That brings us to how they're using that cash, the capital allocation moves.
Yeah, and they were very proactive here. First off, they finished that initial £1 billion buyback early, got it done by the end of October 2025.
Right, ahead of schedule.
But then, almost in the same breath, they announced another £1 billion buyback program.
Another billion, straight away.
Yep, to be completed by the time they report full year 2026 results, so probably next February.
Okay, so that's £2 billion in buybacks announced pretty close together. How does that stack up against the cash they're generating?
Well, that's the interesting part. If you add up all the cash they're deploying this year, the buybacks, plus this big payment for the post-trade deal we need to talk about, it comes to roughly £3.5 billion.
$3.5 billion. But the FCF guidance is at least £2.4 billion. So they're spending more than they're making in cash flow this year.
Exactly. They're funding the difference, about $1.1 billion with new borrowing.
So taking on debt to fund buybacks and this post-trade deal payment, what's the thinking there? Is it pure confidence or maybe feeling some market pressure to boost EPS now?
Look, I think it's probably a mix, but the dominant factor has to be confidence. They clearly believe their shares are cheap and that their future cash flow is incredibly secure.
Okay.
Taking on a bit of relatively cheap debt to buy back what they see as undervalued equity, especially when they're simultaneously locking in structural margin improvements, it makes sense. And it keeps their leverage comfortable, about 1.9 times net debt to EBITDA right in the middle of their target range.
Right. That leverage point is key. They're not overstretching the balance sheet.
Not at all. And this confidence, this willingness to use the balance sheet, it's really underpinned by the biggest news of the quarter, that post-trade solutions, or PTS, transaction. This is the structural shift that changes the game.
Okay, let's unpack that PTS deal. It looked complicated on the surface, selling a stake, but also changing revenue shares.
Yeah, there were a few moving parts. So first bit, they sold a 20% stake in the PTS business. That includes things like LCH SwapClear, but also newer acquisitions like Quantile and Acadia.
Who bought the stake?
A consortium of 11 banks. They paid $170 million for that 20%, which implies, a valuation of about $850 million for the whole PTS unit.
Okay, $850 million valuation seems maybe a bit low, but perhaps that wasn't the main point.
Exactly. That valuation is almost a sideshow. The real story, the thing that fundamentally re-engineers LSEG's profitability for potentially decades, is the change to the SwapClear revenue share arrangement.
Right. They made a big payment related to that, didn't they?
A very big payment, $1.1 billion, paid to the partner banks.
Okay, $1.1 billion cash out. What did LSEG get in return for that massive check?
They bought a permanent reduction in their cost of sales for SwapClear. It's a structural change. Before this deal, the partner banks got a 30% share of the SwapClear revenue.
30%, okay.
Now, that drops. Retroactively for all of 2025, it's cut in half, down to 15%.
Wow, okay.
And then from 2026 onwards, it drops even further, down to just 10%.
From 30% down to 10%. That's a huge cut in the share going out.
It's massive. And crucially, they also extended the term of this new agreement by 10 years. So this new 10% structure is locked in all the way out to 2045.
45.
Wow.
But why would the banks agree to give up such a large chunk of that ongoing revenue stream, from 30 down to 10?
Well, that $1.15 billion payment is the key. It's a huge amount of cash up front right now. For the banks, getting a large, certain sum today can be more attractive than a potentially variable, declining stream over 20-plus years. They can deploy that capital immediately.
Okay, so it's a time value of money play for the banks, essentially.
Pretty much. And for LSEG. This is financially transformative. Management said this change alone adds another 100 basis points at the total group EBITDA margin starting this year, FY25.
Another 100 basis points, on top of the operational one we already talked about.
Exactly. Two distinct 100 basis point margin uplifts materializing, and they project this deal will add 2 to 3% to their earnings per share, EPS, from 2025 onwards.
Okay, that is a structural margin lead. No wonder they feel confident enough to lever up slightly for buybacks. They've just fundamentally improved the profitability profile.
That's precisely it. It de-risks the future cash flows significantly.
Right. Now, let's switch gears to the other major theme they really hammered home on the call.
Yeah.
The whole LSEG Everywhere data strategy, and specifically, defending against AI disruption. This feels critical for their long-term valuation.
Absolutely critical. Every data provider is getting asked about generative AI.
Yeah.
LSEG came out very proactively on this. They stressed that their data isn't just, information, it's embedded financial markets infrastructure.
Trusted, regulated workflows,
Yeah.
that kind of thing.
Exactly. Deeply integrated. And they laid out these data moats, as they called them, to explain why they feel protected. They made a pretty stunning claim, actually.
Which was?
That 90%, 90 of their data and feeds revenue is not replicable by large language models, LLMs, just scraping public data off the internet.
90%. Wow. Okay, That needs unpacking. How do they get to such a high number? What's the breakdown?
They gave a very specific breakdown. So the biggest chunk, 45%, is real-time data. Think high-speed market data feeds from exchanges globally that's built on physics, infrastructure, and AI can't just generate that real-time stream.
Okay, makes sense. Can't replicate physics. What's next?
Another 25% is proprietary or exclusive data. This is stuff like TradeWeb fixed income pricing, which they own, or their long-standing Reuters news agreement, data they control or have exclusive rights to.
Right, unique content. So that's 45 plus 25. 70%.
Then another 10% is specialized data, where LSEG adds its own intellectual property, its own enrichment. They take raw data and make it unique through their own processes and analytics.
Okay, so that gets us to 80% that's protected by speed, exclusivity, or unique IP. What about the remaining 20%? That must be based on public data, right? Like company filings.
Correct. That last slice is based on public domain data, but here's where their argument about curation comes in.
The LSEG curation standards.
Exactly. They argued that for regulated use cases, raw public data is basically useless. It needs to be meticulously sourced, cleaned up, normalized, and critically tagged with unique identifiers, things like the RICS codes or PERM IDs. This allows different data sets to be linked together reliably, concordance, they call it.
So the value isn't just the raw data, it's the cleaning, structuring, and tagging process that makes it usable and trustworthy for financial institutions.
Precisely. An LLM might be able to scrape a million filings, but can it provide a perfectly clean, normalized, tagged feed that a compliance system or a trading desk relies on? LSEG argues no, not to the standard required. Their value is in that trusted, curated layer.
And they have a technical backstop too, right? Something about how customers access the data.
Yes, the Managed Cloud Platform, or MCP. This is really important. It's essentially the secure environment where customers access LSEG data.
And it prevents what exactly?
It prevents customers from just downloading the entire data set wholesale to train their own competing AI models. You access and use the data within LSEG's controlled environment. They monitor usage, but you can't just copy the whole library. It's a technical barrier against disintermediation.
Got it. So a multi-layered defense. Inherent data characteristics, curation standards, and technical controls.
That's the narrative. And they're not just playing defense. They highlighted partnerships with Microsoft, embedding data into Copilot, plus deals with Databricks, Rogo, Snowflake. They're actively trying to integrate AI into workflows using their data.
And this ties into the workspace migration, presumably, getting clients onto the platform where these AI tools can be deployed.
Absolutely. Workspace is the foundation for delivering these new capabilities. We should expect to hear a lot more about this at their upcoming Innovation Forum in November.
Okay, shifting focus slightly to the market context. How is LSEG positioned competitively now, and how's the broader environment helping or hurting?
Well, competitively, they highlighted some real progress. They claim they've moved from being, say, the number 6 player in pricing and reference data a few years ago up to number 3 now.
Number 3, who are they competing with there? The big U.S. players.
Yeah, implies they're taking share and competing more directly with the established giants in that space. And they attribute that to sustained investment in both the data content itself and how they distribute it.
And the macro picture. Is it a tailwind?
Generally, yes. You know, lingering volatility, ongoing focus on interest rates, that tends to drive trading activity, which is good for their trade web platform and also for OTC clearing volumes in SwapClear. So the overall environment is pretty supportive for key parts of their business right now.
Okay, so looking ahead, what are the key things investors should be watching for? The catalysts.
Well, first up is that Innovation Forum you mentioned, November 10th. That should give much more visibility on the product pipeline, especially the AI stuff.
Right. See the demos.
Exactly. Then we'll be looking for concrete examples, tangible wins from those partnerships with Microsoft and the others, showing AI integration isn't just talk.
Makes sense.
And of course, the big one financially is the start of 2026, when that new lower 10% SwapClear revenue share fully kicks in. That's when the full impact of that deal really hits the run rate.
A potent mix, as you said earlier. Strong execution, structural improvements, and tech defense.
It really is. Sets things up nicely.
Which naturally brings us to our This Is Not Financial Advices segment. Time for the high conviction, maybe slightly outrageous, but plausible trade idea based purely on what we've heard from this update.
Okay, let's do it. The trade idea we're calling the structural margin leap.
The structural margin leap. Okay, what's the core thesis? Why this trade?
The thesis is simple. We think the market hasn't fully appreciated just how permanent and significant these margin improvements are. LSEG is making a real shift, moving from being seen as just an exchange or a data vendor towards becoming more like a highly reliable, cash-gushing financial utility.
Okay, a utility-like perception shift. And the setup, what makes this timely?
The setup is right here in the Q3 results. Management just delivered 2 separate, clear 100 basis point boosts to the EBITDA margin guidance, one from operations, one structurally locked in from the SwapClear deal. At the same time, they confirmed that strong $2.4 billion plus FCF outlook and slammed down another $1 billion buyback, making it $2 billion total being deployed relatively quickly.
Right. The evidence seems pretty clear from the call. So what's the actual trade?
The trade is long LSEG. Simple as that. We're betting on a pretty rapid re-rating of the stock's multiple over, say, the next 6 months. That timeline lines up nicely with the completion of that accelerated £2 billion buyback program by February 2026.
And the justification for that re-rating?
It comes down to that combination of factors. You've got the guaranteed lower cost of sales from the SwapClear deal locked in for 20 years, remember? Plus, you have those very specific data moats they detailed, arguing 90% 80% of their core data revenue is safe from AI disruption. Put those together.
Yeah.
And we think LSEG deserves to trade closer to a high-margin, data-centric IP company rather than a traditional, more cyclical market operator. The trade is essentially betting that the improved FCF yield, catalyzed by the aggressive buybacks, forces the market to recognize this new, more resilient, higher margin profile and award it a premium valuation.
A compelling case built directly on those twin margin boosts and the data defense story. Okay, so just to quickly recap for you listening, the big takeaway is high confidence from LSEG. It's driven by solid operational execution, that really significant structural change in the post-trade economics, and a very clear, detailed strategy to defend their valuable data assets against AI threats. They seem to be pulling the right levers for long-term value.
Absolutely. And maybe the final thought to leave you with is this. Think about the long-term impact of that SwapClear deal. LSEG essentially paid up front to lock in lower costs and higher margins until 2045. 2 decades of enhanced profitability baked in. Is the market truly pricing in that kind of long-term certainty yet? That's the multi-billion-pound question.
A very powerful question to ponder. And just a reminder, of course, everything we've discussed here today is purely for informational and discussion purposes. It is absolutely not personalized investment advice. Please do your own research. Thank you for joining us for this deep dive. We hope you'll continue exploring these developments yourself.